Hello, everyone. I'm not going to ease you into this because the market isn't T easing anyone into what S coming. If you're watching gold and silver like they're just numbers on a screen, you're already behind. Because the next shock may not be a candle that spikes or dips. The shock may come the moment you try to act and realize the real market isn't T, the paper market. In this video, I want to strip away the headlines and talk about what's actually happening underneath them. Why physical delivery matters more than price targets. Why sudden pullbacks can be nothing more than leverage getting washed out. Why persistent premiums in Asia are a louder signal than any chart pattern. And why the biggest risk right now may be simple availability. Yes, we're going to talk about the big round numbers people obsess over. Triple-digit silver and multi-$1,000 gold. But I'm also going to explain why those numbers are not the finish line. They're the signal that the real repricing still isn't finished. Let's start with something that gets misunderstood every cycle. Corrections are normal. They always have been. Markets run hot, they breathe out, and then they keep going. Silver can slide from the mid-90s into the mid-80s. Gold can fall from the high 4,000s into the mid-4,000s. That kind of move is not a prophecy of collapse. Most of the time it's positioning, margin pressure, leverage being forced out, but here's what isn't normal. When the physical market is tight at the exact same time the paper market is screaming top. That's where people get trapped. They sell, they hesitate, they wait for confirmation, and then they discover later that the real damage wasn't price, it was access. So instead of staring at price targets like they're fortune telling, let's look at behavior. Let us look at what the market does when no one is watching, because that S where the truth leaks out. One of the most overlooked signals in precious metals is delivery activity on major exchanges. People love open interest. They love futures curves. They love technical indicators. But when you see unusually large amounts of metal actually being taken, delivered, removed, accounted for, that's not noise. That's decision-making by participants who don't care about headlines or daily volatility. And recently, delivery activity has been extraordinary. Here's the part most chart watchers miss. A futures contract can represent thousands of ounces, but taking delivery is different. Delivery is slow, it's paperwork heavy, it ties up capital. Most speculators avoid it completely. So when delivery spikes to record levels, you're not watching gamblers. You're watching entities that want the metal itself, not the trade. Which leads to the uncomfortable question. Who needs that much silver right now that they're willing to go through the hassle? Because if it's not retail, and it's not short-term leverage, then it points to something else entirely. Strategic stockpiling, industrial security, or reserve-style behavior. And none of those evaporate just because price dipped for a week. Here's the cliffhanger you need to hold on to. The biggest buyers rarely announce themselves. They let the public argue about candles while they quietly build positions. And when the public finally notices, the public pays more. We've seen this pattern before. Insiders reposition first, narratives catch up later, and by the time the story feels obvious, the easy opportunity is gone. So if you're waiting for a headline that says, the shortage is here, you'll probably see it after the premium has already done the damage. And that word matters. Premium damage. A premium isn't just a fee. It's a tax on hesitation in a tight market. There was a single month that produced the largest silver delivery in that exchange. That's recorded history for that month. Over 64 million ounces. Not above average. Not notable. The largest. And if you're tempted to dismiss that because it was a delivery month, look at what happened next. The following month, normally quiet, still saw close to 40 million ounces delivered. Stack those together and you're looking at roughly 110 million ounces moving in about 40 days. Now ask yourself something, honestly. How often do you hear that discussed in mainstream coverage? You don't. You hear about tech rallies, you hear about rate speculation, you hear a new buzzword every week, but the quiet transfer of real metal? Silence. And that silence matters, because the people taking delivery at that scale aren't panic sellers. They're usually the best funded, most informed participants on the planet. Here's something that makes people uncomfortable. Performance isn't the key story right now. Yes, gold and silver have outperformed certain benchmarks during periods when attention was elsewhere. That's notable. But the bigger story is the drain, the settlement, the preference for physical. Because when well-capitalized participants prioritize delivery, they're communicating with actions, not opinions. That changes how you should interpret paper price moves. A dip doesn't automatically mean safety. Buying later isn't always an option, because later is when everyone tries to buy at once. Now let's talk about mechanics, because this is where things turn explosive. If you want to understand real price discovery, stop asking, what's the target, and start asking, who is taking metal and why? For years, gold and silver have traded in a system dominated by paper promises. Prices are often set by leveraged contracts, not by people exchanging bars. That system works as long as most participants accept paper settlement. Delivery is where the system has to perform. That's why margin policy matters. When exchanges want to cool a market, they raise margin requirements. Leverage traders suddenly need more cash just to stay in the game. Many can't. They're forced to sell. Price drops. The crowd declares the top. This playbook worked brutally well in past cycles, but here's what's different now. Margin hikes only hurt leverage. They don't hurt buyers taking delivery with cash. Recently, margin requirements jumped roughly 30% almost overnight. If you were trading on leverage, it was a punch in the mouth. And yet, large-scale delivery didn't disappear. So ask the obvious question. Do you think the biggest buyers are using margin? Or are they operating in a completely different league? That distinction matters, because it tells you whether the market is being driven by weak hands chasing momentum or strong hands positioning for structural change. Now consider this. There was a recent case where a major trading desk leaned short on silver, expecting a blow-off top and a sharp collapse. They even had a defined stop level. And the market did what it always does when too many people feel certain. It went the other way. Why does that matter? Not because anyone should cheer losses, but because it shows the old playbook isn't working as cleanly. In previous cycles, institutional pressure paired with margin stress could force dramatic reversals. But when demand is structural, the market absorbs those hits. Which brings us back to the same conclusion again and again. Physical is tighter. This is also why technical analysis alone can fail in moments like this. Charts aren't useless, but when price is being steered by leverage, margin rules, and settlement mechanics, the signal gets distorted. Delivery cuts through that distortion, and that brings London back into focus. If hundreds of millions of ounces exist on paper, but most of it is already spoken for, effective liquidity is far smaller than it looks. Add massive paper exposure on top, and the system only works if most participants never demand delivery. When they do, spreads widen. Delays appear, premiums detach from spot, and it's not just silver. Gold deliveries have been rising too. Boring assets don't behave like this. Boring assets don't create persistent regional premiums. They don't cause settlement stress. They don't force record deliveries in off months. Now zoom out, because this is where it becomes personal. When institutions publish frameworks suggesting gold could be valued orders of magnitude higher under certain reserve comparisons, the number itself isn't the point. The logic is. Liabilities have grown faster than trust. In a system layered with debt and derivatives, everything depends on confidence in settlement. When that confidence weakens, people move toward assets that settle without permission. That's why you're seeing diversification, alternative settlement systems, and renewed interest in neutral reserves. This isn't about politics. It's about risk management. Here's the psychological trap. People hear numbers like $100 silver or $5,000 gold and assume that's the end. Fireworks then collapse. But if the move is driven by a deeper realignment of trust and settlement, those numbers aren't the end. They're evidence the old pricing regime is breaking. And here's the paradox. Price can correct while physical tightens. That's how people end up asking, if price is down, why is everything unavailable? Because paper selling doesn't create new metal. So here's how I think about it. I don't plan around perfect timing. I plan around volatility. I focus on sizing, pacing, and patience. I respect pullbacks without treating them as failure. I watch delivery, delays, and premiums more than online sentiment. And one final signal. When something important is consistently ignored, that ignorance becomes information. If the public understood delivery, behavior would change. So the public is trained to watch the wrong scoreboard. At the end of the day, this comes down to a choice. Early and calm, or late and emotional, because the crowd always arrives when price is obvious, premiums are painful, and decisions get sloppy. I'm not telling anyone to go all in on anything. I am saying stop treating precious metals like a meme and start treating them like insurance in a world where settlement risk is rising. Because the next crisis may not be a red candle. It may be a missing bar. So watch the quiet signals, not the loud opinions. They've already started talking. This is where we need to slow down and talk about something most people gloss over: the difference between inventory and available inventory. A well-respected specialist who understands the London system has explained that the reported silver held there is massive, hundreds of millions of ounces, possibly 700 or 800 million, depending on how it's counted. But here's the part that changes everything. Most of that metal is not sitting idle, waiting to be bought. It's already owned. Much of it is tied up in ETFs, pooled storage programs, and long-term allocations. It belongs to someone. It's not available just because a price chart dipped on your screen. At the same time, the market often talks about a much smaller number, the so-called free float. Around 140 million ounces gets mentioned, but even that figure has been challenged as overstated. Once you account for metal that's pledged, encumbered, or effectively committed, the truly free supply may be far smaller than advertised. And then comes the uncomfortable part. The amount of paper claims referencing that metal can be enormous, billions of ounces in derivative exposure tied to a much smaller physical base. So let me ask you a simple question. What happens when too many people try to convert paper promises into physical metal at the same time? You already know the answer. The system stretches, then it delays, then it makes excuses, and eventually it breaks. We've seen settlement timelines extend dramatically. On paper, delivery should be quick. Yet there have been periods where buyers were told to wait weeks just to receive bars. The explanations usually sound harmless. Logistics issues, staffing problems, transportation delays. But in a multi-trillion-dollar financial system, the excuse itself isn't the point. The signal is, because a long wait in a market that claims to be highly liquid is a flashing warning sign that liquidity is thinner than advertised. That's why delivery behavior matters so much. It isn't theoretical, it's a real-world stress test. It answers a very simple question. When pressure shows up, does the system deliver or does it stall? Now let AS talk about something that quietly shapes investor behavior more than most people realize: instant gratification. Over the last decade, investors were trained to expect miracles. A small group of assets delivered extreme returns, 5-fold gains, 10-fold gains. Over time, that distorted expectations. A steady 7% annual return started to feel boring, outdated, almost insulting. But the real world doesn't reward impatience forever. And here's the irony. The same people who dismiss slow compounding often get destroyed by slow decay. They don't notice a system weakening because it doesn't collapse overnight. Instead, it erodes them gradually. Small losses of purchasing power, small increases in costs, incremental expansions of debt, quiet changes to settlement rules, until one day, all those paper cuts add up to something far more serious. That's why the current environment is dangerous. Many people are waiting for one dramatic event, one headline moment. But the real story is a series of quiet structural shifts that accumulate into a regime change. You'll hear plenty of narratives about politics, trade policy, and institutional maneuvering. I'm not here to sell you any single storyline. What matters is the common thread. When powerful interests feel exposed, they rely on rhetoric. Narratives become tools. If risk needs to be unwound, explanations appear that make the process seem reasonable, even inevitable. This isn't new. We have seen major institutions implode after carrying massive short exposure in metals when prices moved against them. That history doesn't get taught to everyday investors, but it absolutely shapes how risk managers think today. Once you've seen a short position turn fatal, you never treat metals casually again. So when you hear that large institutions may be shifting from leaning short to leaning long, don't get distracted by speculation. Ask what would force that shift. One answer is increasing attention on physical delivery and tightening supply. Another is the realization that relying on a single reserve framework carries risk in a world where financial tools can be weaponized. That brings us to the reserve question. A large asset manager recently outlined scenarios exploring where gold prices could land if they were required to balance global monetary liabilities. By comparing central bank money to gold reserves, they derived implied values in the tens of thousands per ounce, some even approaching six-figure levels depending on the assumptions. You don't need to believe those numbers will materialize tomorrow. The point is that institutions are openly discussing the logic. That tells you something important. Trust is being re-examined. And when trust is questioned, currencies and bonds can be repriced in ways that surprise people. Look at what's changing. More trade is being settled in local currencies. Alternative financial networks are expanding. Infrastructure designed to reduce dependence on a single system is becoming operational. This isn't a headline event, it's a structural shift. And when infrastructure changes, reserve assets change with it. Gold has no counterparty. It isn't someone else's liability. That's why it keeps resurfacing whenever trust thins. Silver occupies a unique position. It's both monetary and industrial. It's smaller, more volatile, and when demand accelerates, it doesn't move politely. To make this tangible, think in terms of weight. Not long ago, roughly 45 to 50 ounces of gold represented about $100,000. Today, that same value is closer to 20 ounces. The stack got smaller, not because gold changed, but because purchasing power did. Silver shows the same compression. What once required 1,500 to 2,000 ounces to represent that value is now closer to around 1,000. The metal didn't get lighter. The currency did. And yet, where is the daily coverage explaining that? Where are the segments pointing out that the same money now buys dramatically less metal? You don't get that conversation. You get distractions. Now, let us return to the question everyone asks during big moves. What do we do at major milestones? The answer is simple, but not easy. Stop thinking in absolutes. Start thinking in signals. A round number means nothing by itself. What matters is what's happening around it. Are premiums shrinking or expanding? Are deliveries slowing or accelerating? Are settlement timelines normalizing or quietly stretching? A market can print a high price and still be in the early stages of repricing if the paper mechanism is losing control. Here was the cliffhanger you need to hold on to for the next part. The most important price in metals isn't at the quote on the screen. It's the premium required to turn that quote into something you can actually hold. And yes, that premium can explode even during a correction. I expect volatility. I expect pullbacks. That doesn't concern me. What does concern me is a system reaching a point where access, not price, becomes the constraint. That's why certain dips matter, not because price action is sacred, but because leverage-driven sell-offs can create opportunities while the underlying structure remains intact. There's one more layer worth addressing: media narratives. When markets come under strain, stories multiply explaining why you should exit, why the move is over, why fear is justified. The language changes, but the goal is the same: convert patient holders into weak hands. That's why I focus on signals that are difficult to fake: delivery behavior, persistent premiums, and settlement friction. In a healthy system with abundant supply, those stress markers shouldn't keep flashing. Now, a word on arbitrage. People imagine it as a magic fix that instantly erases mispricing. In tight markets, arbitrage doesn't eliminate the problem, it exposes it. Every attempt to exploit the spread drains metal from the cheaper side. Instead of closing the gap, the process can reinforce it. The system can look stable right up until a major participant wants physical metal and discovers the free float is far smaller than expected. Picture this scenario. Silver corrects. Headlines declare the move finished. Speculators exit. Sentiment cools. Meanwhile, physical demand continues. Premiums stay elevated. Delivery numbers remain stubborn. Delays don't fully normalize. The public relaxes at the exact moment the structural drain continues. Then the next surge arrives, and people chase at higher prices and higher premiums. That's how wealth transfers from the impatient to the prepared. Now let's tie everything together. What we're re-seeing is a market long priced through paper mechanisms being increasingly challenged by physical behavior. Not one event, but repeated stress. Large deliveries, persistent regional premiums, settlement friction that doesn't disappear, institutional frameworks openly questioning how value should be anchored. At the same time, reliance on a single reserve system is being reassessed globally. Call it geopolitics, self-interest, or risk management, the result is the same. Alternatives gain importance. In that environment, gold and silver aren't just trades, they're signals of trust. So don't confuse corrections with reversals. Corrections reset leverage. Reversals require demand to fade and physical pressure to ease. Let me leave you with this. The participants that matter most in this market are often the quietest. They don't chase headlines, they don't seek attention, they take delivery. And when actors with the capacity to absorb tens of millions of ounces move into physical assets, it's rarely about a short-term trade. It's about positioning for a longer-term shift. If you're building exposure, think in layers. Time, access, risk. Don't design a plan that depends on perfect timing. Design one that survives volatility. Because in markets like this, the loudest signal is usually the one no one is talking about. Don't just watch the price, watch the deliveries, watch the premiums, watch the delays. When those start moving together, the story changes fast.